Welcome back. In today's video, we're going to be discussing what is going on in the cycle with crypto, with the paper Bitcoin that we've been talking about. And this has a lot to do with it. Aster, their quiet relisting on DeFi Llama leaves big gaps in data. Now, just a few weeks ago, we heard that DeFi Llama delisted Aster, which is a perpetual futures DEX, very similar to Hyperliquid. And they removed it because they said that there was a lot of fake trading and wash trading and just to kind of pump the volumes up. And this is very similar to what we have been talking about with specifically the Bitcoin halving cycle, where people are still top chasing. They're chasing the returns that people got in the first cycle of Bitcoin. They're chasing the returns that people got in the second cycle of Bitcoin, and even the third cycle, right? But if you really look at the data, we are seeing diminishing returns over time. And in today's video, we're going to be exploring how this all ties together, how the banks are now saying that bank coins are going to be more popular than stable coins. We're going to talk about how the banks believe that not in the valuations of these coins, but the usage of these blockchains that are underlying. But we're going to start right here with the law of diminishing returns. And by the way, this is the Cryptoviser podcast. We talk about everything crypto, blockchain, and investing every single day of the year. Sometimes we do deep dives into individual cryptos or stocks or other assets. And sometimes we talk about the macro environment like what we're talking about today. So make sure you guys are subscribed to the channel. Give the video a free thumbs up, and you can check out my other videos on this channel. We've been uploading almost for a decade now, every single day of the year. And so if you watch my videos on a regular basis, you kind of have a good understanding of this stuff. But if this is your first video, I would definitely recommend watching a few more videos so that you can get more accustomed to the thesis and kind of the line of thought that we have about these markets. But let's start right here with the law of diminishing returns. Now, this tweet was posted saying, stop listening to Bitcoin gurus, and Finance a Lot said people are starting to get it. Now, they posted a chart that shows Bitcoin price increases clearly diminishing over time. And this is something that we've been talking about. And we still have, new entrants into the space. I mean, some of these big entrants, like the Cardones, they sold their beachfront property in Florida, took the proceeds and purchased Bitcoin just a few weeks ago. They made the announcement that they bought more Bitcoin at $111,000, which personally I think is the macro top of the cycle. But they don't fully understand this. And a lot of this is, number one, top chasing, right? Everybody wants to get those same returns that the early investors, the early Bitcoin miners, the early developers have in Bitcoin, in Ethereum, in Solana. But the deal is, as you go through more time in these cycles and in the markets, you have more participants. I mean, we have Michael Saylor purchasing hundreds of billions of dollars, hundreds of millions of dollars on a regular basis in Bitcoin. And some of these other Bitcoin treasury companies doing the same. Some governments are doing the same. But we're not even seeing the price of Bitcoin move. Well, why? Well, the people from the first cycle, which is this top purple line, they are exiting their positions now, right? Because now they're getting hundreds of millions of dollars for holding onto this asset for 10 years. And a lot of people are chasing those same returns, which I don't think are going to occur anymore. We're still going to have appreciation. Yes, we're still going through Bitcoin halving cycles. The price will adjust based on inflation, based on the mining difficulty, based on the rewards rate decreasing. But it's going to diminish. It's going to increase less and less, as you guys can see from this chart. This top line is the first cycle. This middle line is the second cycle. This blue line is the third cycle. And the black line is the cycle that we're in at the end of 2025. And you can see that every cycle, this is a scaled up version, right? So it shows you percentage gains. Every cycle, we're having less and less percentage gains. But people are still chasing the gains from the previous cycle. I mean, I just showed a video in the middle of the year from Saifedean Mamous, who's a well-known Bitcoin expert. And he was being interviewed by a Bitcoin journalist, Bitcoin maximalist. And she was like, wait, you think we're at the end of the cycle? But last cycle, this happened. And last cycle, this happened. And in my view, and I said on that video that I posted, like what happened in the previous cycle has no bearing on this cycle, has no bearing on next cycle. It can give you sometimes a guide, right? How many days since the halving is when you're going to top out? Yeah, that's a guide. But to say, well, in last cycle, we went up this much, so this cycle, we should go up this much. And it's like, no, this is this cycle. It's not last cycle. But a lot of people don't get it. But what is the law of diminishing returns? The law of diminishing returns is an economic concept that explains how, beyond a certain point, increasing one input while keeping others constant will lead to progressively smaller gains in output. For example, a factory employs workers to manufacture its products, and at some point, the company operates at an optimal level. With all other production factors constant, adding additional workers beyond this optimal level will result in less efficient operations. Well, if we related to Bitcoin, Michael Saylor and MicroStrategy's thesis of continually buying more and more through issuing shares and putting out all types of debt, it worked at the beginning. And we saw MicroStrategy go up like 20x. And it also helped push the Bitcoin price up because now you have a new buyer in the market. But now that new buyer is at optimal level, right? The market has already adjusted to these constant purchases of Bitcoin, the constant movement of Bitcoin, and people are starting to exit that trade saying, I'm not going to keep buying MicroStrategy or holding MicroStrategy when MicroStrategy is diluting my shares. And the Bitcoin market is saying, okay, well, if you have Bitcoin and you need to sell it, well, you're going to be able to sell it without impacting the price because Michael Saylor and MicroStrategy are going to keep buying the Bitcoin. So now that becomes the normal. And so it's not like the first cycle where you had nobody buying Bitcoin, then you started to get some buying of Bitcoin, then it started to get some speculation in Bitcoin. The second cycle, you started to get more of that, right? More, wealthy people kind of dabbling in it. Then the third cycle. Now we're in the fourth cycle, and we have institutions, we have publicly traded Bitcoin treasury companies, we have governments buying Bitcoin, and that is now the norm. So that is the new normal level. And so the law of diminishing returns is related to the concept of diminishing marginal utility. It can also be contrasted to economics at scale. After some optimal level of capacity utilization, the addition of larger amounts of factor of production will inevitably yield decreased per unit incremental returns. It's the same thing that you're seeing in the MicroStrategy stock itself. And so this is the law of diminishing returns. And I'm not saying this based on my analysis or opinion. It's based on data. First cycle, 48x. Second cycle, 16x. Third cycle, 4x. Now, 1.8x. And again, this is from the top of the market, right? Even if you look at it from the bottom of the market, 126,000 is so far the 2025 top, right? And so the bottom of the market was basically around 15,500 after the FTX collapse. So from 15,500 to 130,000, that's basically almost a 10x, like 9x to 10x, okay? That's significantly less than the previous cycle where we went from 2,000 to 70,000, right? That's a 35x. So we went from 35x to a 10x. What do you think next cycle is going to be? But people are still chasing the first cycle's output, the first cycle's run. And in my view, that is a huge mistake because there's a lot of other things going on in the market, which we're about to talk about, especially when we're talking about these perpetual futures and the paper Bitcoin. And a lot of people are also, they're saying, but Cryptoviser, BlackRock is buying. Yeah, but they're also selling. Spot Bitcoin ETFs shed $1.2 billion in the second largest weekly outflow since their debut. And this happened in October in 2025, which I've been saying is the end stages of the Bitcoin cycle based on this chart, the Bitcoin days since the Bitcoin halving, and the previous two all-time high days after the halving, and a lot of other macro factors. Go look at my other videos where we just type in Cryptoviser top of market or Cryptoviser top, and you will see all those videos where we talked about the market has topped out. Meanwhile, according to Soso Value data, spot Bitcoin ETFs saw $366 million in net outflows in one day alone in October, bringing the week's total net outflows to $1.23 billion, a sharp reversal from the previous week's inflows of $2.7 billion. So they're saying, but Cryptoviser, BlackRock is buying. Yeah, all the ETFs are buying. They bought 2.7 billion and gave back half of it the next day, the next week, right? And so just because you're seeing inflows does not mean you're not seeing outflows. And then we have the paper Bitcoin, the paper crypto, which is trading crypto without actually touching the order books or the actual crypto itself. So we've been hearing this a lot, especially with the Bitcoin treasury companies saying that Coinbase and MicroStrategy, they're trading paper Bitcoin. Well, what is paper Bitcoin? Paper Bitcoin is a derivative of Bitcoin. It's not the actual Bitcoin itself. Now, I personally don't believe that Coinbase is trading paper Bitcoin or MicroStrategy for that matter. But there is paper Bitcoin out there. And where is it coming from? It's coming from these perpetual DEXs like Aster. So now we're hearing Aster has, and I'm going to explain this a little bit more in depth in a second. Aster's return to DeFi Llama came with missing historical data, leaving transparency questions unresolved across the DeFi ecosystem. Now, Dragonfly managing partner flagged the development on X, noting that there was no public discussion or announcement from either Aster or DeFi Llama, noting big gaps in historical data, and asked how DeFi Llama founder if the numbers are now legitimate. Responding to the post, the DeFi Llama founder said that the team still could not verify the numbers, describing it as a black box. He added that while DeFi Llama is developing a new system to include more metrics, Aster's team requested to be relisted in the meantime. He said, "We're working on a solution that will include other metrics to make this better. But since this might take some time, Aster team asked us to relist them meanwhile." And they did. And I think that that's an okay thing to do. Now, there were inconsistencies detected and on-chain data. There was basically a lot of questions about whether there was wash trading and fake trading on Aster. Well, what is Aster and what is Hyperliquid? Because these are very similar protocols, right? They're what they're called perpetual futures contracts or perpetual trading. Now, what you have to understand about perps or perpetual trading is this effectively is what brought the market down in the previous cycle, because this is what FTX was doing at a rate you cannot even imagine. And we know this for sure. They were definitely one of the only exchanges at the time, FTX, that was trading perpetuals. And perpetuals is a derivative, but it doesn't touch the actual crypto. So you can be betting for or against a crypto and not actually touch the actual crypto, right? You're trading a paper contract. You're just trading, it's make-believe crypto. It's not really crypto you're trading. You're trading a futures contract on a perp, but it's not the crypto. So effectively, if all of this volume from Hyperliquid trading and Aster trading in perpetual specifically, you can see perpetual volume in the last 30 days, $145 billion on Aster, $309 billion. So basically $500 billion in 30 days just on these two DEXs. Now imagine all of that trading was actually being done in the underlying asset itself on Bitcoin order books, Ethereum order books, Solana order books. The prices of these coins would go up because these are fixed supply coins for the most part. Where in perpetuals, there is no supply limit, right? So if you're buying, you could buy effectively a long on Bitcoin, 1 million Bitcoin, and it won't impact the price of Bitcoin directly. It will, because that's what perpetual futures do. They derivative markets are supposed to derive their value from the underlying asset. But what has happened over time, and we saw this in the previous cycle with FTX, is that these derivative markets like options and futures and perpetual futures, they basically direct the price of the underlying asset. Why does this happen? Well, if you start to see massive trading on Hyperliquid and Aster, and people are betting that the price is going to go up, people start to wonder, somebody knows something. We need to go buy actual Bitcoin because the price is about to go up. All the futures contracts are going up on it. And then the actual asset goes up. And if people are betting against it, people are like, what? They must know something. Something's about to go on. There's about to be a massive liquidation, a massive sale. And then the price can go down. And if the main crypto price moves up or down just a little bit, you can have massive liquidations in the futures contracts, which can also affect the underlying asset indirectly but directly. It's very confusing, but the easiest way to look at it is in the previous cycle in 2021, FTX was not listing Litecoin, which is the most regulated crypto outside of Bitcoin and Ethereum in the world. They did not have Litecoin on their exchange. They did not have Cardano on their exchange, and they did not have Internet Computer on their exchange. But where did they have those coins? In perpetuals. Think about that. The largest, quote unquote, largest crypto exchange in the world, FTX, didn't have 3 of the largest coins listed on their exchange, but they had them listed in perpetual futures. And what happened to all those coins? Now, Cardano did go 100x from the bottom to the high, but a lot of people, including myself, thought we were going to go much higher based on mostly hype, mostly hype. But if you look at Internet Computer, launch, $200 down to $2. Litecoin hit its all-time high, straight back down. But meanwhile, FTX, FTT token, all the FTX coins went up. Why? Because they were pushing it up through perpetuals. I don't still fully understand exactly how this mechanism fully operates, but that's basically the idea. $500 billion, $500 billion in 30 days between Aster and Hyperliquid. And there's been effectively no movement in the actual cryptos because they're not actually touching the actual cryptos. And so this is paper Bitcoin, it's paper crypto. You could buy 1 million contracts for Bitcoin to go up, which in the regular Bitcoin market, if you bought 1 million Bitcoin, the price of Bitcoin would probably go over $1 million. But because they're not actually touching it, they're creating new Bitcoin, paper Bitcoin, not real Bitcoin that you can trade on. And it's not just Aster and Hyperliquid. These are just DEXs that you can trade on. Coinbase has this, Kraken has it, Binance has it. Most of the crypto exchanges have perpetuals. And I said in the last cycle, if perpetuals become big again, this is a huge liquidation risk. I mean, it's in the name, hyperliquidation. DIS before Aster is disaster, right? And that is effectively what these DEXs, the impact they can have on the market. This is the paper Bitcoin. And what DeFi Llama is flagging here of fake trading or inconsistent data shows you that there is the potential to manipulate the entire cryptocurrency market without actually touching the cryptos. And that is a huge risk. And by the way, there's also extreme leverage on these exchanges. This is a huge risk that I don't think a lot of people are taking into account and fully understanding either. You can see that the volumes of perpetuals continue to go up on Hyperliquid, on Aster, and the prices of cryptos, for the most part, in a macro sense, have gone down or barely moved up. And that's because people are not trading the cryptos anymore. They're trading perpetuals, paper crypto. And by the way, the same thing happens in the stock market to a different degree because you have options, right? People are not even buying Bitcoin anymore. They're just buying they're buying calls or puts, but mostly calls on the Bitcoin ETFs. Because now you can bet on the Bitcoin in a leverage type of play without actually touching the actual crypto. So the risk is lower and the reward is potentially much higher. While this is good for portfolio growth and for trading, it's very bad for the fundamentals of these ecosystems because it creates fake metrics in the market. It creates a disconnect from the sentiment, where the sentiment may be bullish, but because of these perpetual futures, it can push the market down significantly and based on absolutely nothing besides a few margin traders that are playing with extreme leverage and betting against a coin. So a lot of people are not looking at this. But again, this goes back to diminishing returns. The more products you have built And the more like institutions that are joining this investment party, the more paper Bitcoin is going to be created, the more leverage trading is going to be created. And the more leverage you have in the market, it appears like there's a benefit there. But people who are trading in these markets, the leverage market or the perpetuals market, they're just day traders or looking to extract value. They're not buying for long term. So you could be a long-term investor and believe in the vision of a company or a stock or a crypto, but just based on that and based on the understanding that you have these leveraged plays that are not even affecting the underlying asset, your long-term investment can just go to zero, as we saw in the previous cycles. And the more I see in Aster and hyperliquid trading going on, you can see that in October, we hit a new high of volume, $15 billion, $30 billion in one day. And so the more leverage that we see here going on, the more risky it gets. And the more risky it gets, the more leverage people are going to be playing in the market. And so it becomes a spiral where you can't go higher, diminishing returns. You can't go higher anymore because you have all these leverage plays betting against your long-term position. And they didn't have that in the first cycle. It was pure Bitcoin play, pure supply demand, pure fixed supply. Second cycle, same thing, but to a less degree. Third cycle, same thing, but even to a less degree. Now we're in the fourth cycle and you're competing with 2 million other cryptos, other stocks that are involved in cryptos as well. And these dexes that are global, that anybody can, there's no rules effectively, because what goes in the US may not go in Asia. What goes in Asia may not go in the US. So these leverage plays that you don't even know who's on the other end. And so this is effectively why they don't have 100x leverage in US regulated markets. But on these dexes, you could do 100x leverage. And people are doing this. Now they're getting wiped out. And the more they get wiped out, the more market orders and sell pressure you see in the market, which again adds to the diminishing return conversation. So I hope you guys understand what I'm saying here. I'm not trying to be bearish. I'm just trying to lay out that Aster also popped up in the end of 2025, which effectively is the macro end of the cycle for Bitcoin, specifically looking at days since the halving. Hyperliquid's been around for a while, but what have we been seeing? Now, $500 billion in just 30 days was traded on these two exchanges. And it may be even more, because we have a missing data here for almost an entire month for Aster, or 2 months. And so you guys really need to understand that. And then where are we else in the cycle? Well, Elon Musk posts his pet dog Floki on X and the meme coin pumped 29%. Guys, this doesn't happen in the beginning of a bull market. This happens at the end stages of a bull market where the coin moves just based on a post of a dog from Elon, right? And I want you guys to look at this. MasterCard Crypto Senior Vice President unpacks the industry's mass adoption problem. Now, the MasterCard Crypto Senior Vice President and Wallet Connect CEO agreed that crypto still has to improve its user experience before the next wave of adoption can occur. So he's basically telling you, we're at the peak of adoption for this cycle. He said, for me, the bar in terms of user experience is really a tokenized debit card on my iPhone. The industry needs to mature and go in this direction. He said, we need an awful lot of investment into crypto user experience to make such improvements happen. He thinks that maybe only 3 to 5% of people are willing to have a crypto-first mindset to deal with things like bridging assets or other crypto friction points that can spark confusion or incur wait times or extra fees depending on what's being used. And so, again, right, if you're in crypto, and you're holding a large quantity of crypto, like this is everything that you know. But there's still a lot of friction. There's still a lot of fees. There's still a lot of slowness on the chain and connecting these secure networks, right? Because if you think about Visa, MasterCard, American Express, these are secure networks, private networks, the banks, private networks. JP Morgan is not against blockchain. They say they're not against crypto either, but that's questionable. But the thing is, the reason they like their own JP Morgan blockchain versus Ethereum is because they control everything. It's a closed system. It's not a decentralized open network. Because once you get into that sense, there's a lot more risk. And we haven't, and by the way, the fees are all within the closed ecosystem on JP Morgan. So JP Morgan makes money. On Ethereum, they don't. And so you could say, well, that's just the way that it is. It's like, yeah, but they're not going to play that game. And that's a big hurdle that we have to get past. And this is why I think Citi Posits Bank, Citi says that bank tokens may be more popular than stable coins. So Citi has raised their base case projection for stablecoin issuance to $1.9 trillion by 2030. On day 3 of a conference, a senior research analyst on Citi's future finance team presented the findings at the Bank Stablecoin 2030 report, calling the stablecoin boom blockchain's ChatGPT moment for institutional adoption. She pointed to a huge surge in announcements from digitally native firms integrating stablecoins into commerce, payments, and real-world applications, and noting that big e-commerce names are partnering with wallet providers to accept crypto and stablecoins. Stablecoin issuers could become a top treasury holder, potentially more than any single jurisdiction today, the report says, with $1 trillion plus in T-bills by 2030. But she also cited regulatory tailwinds, including the Genius Act and offshore international demand for holding USD as primary drivers of stablecoin growth. And so this is something to think about, right? Stablecoins are growing, but effectively the banks are in control because these stablecoin issuers have to hold either dollars at banks or dollar denominated assets through the Treasury or through the Federal Reserve, which is also tied into the bank as well. So are they doing these on public networks? Now, the answer is yes, right? Think about Tether and USDC. They are deploying to Ethereum, Solana, all these different public networks, but they're not, people are surprised that they can freeze coins and seize coins. But that's the point, because they're not just going to put it on a network where they don't have control of the money. And it seems like some people in crypto still think that that's the way that it's going. It's never going to go that route. And so understanding all of this, you can understand that while stable coins and banks joining the game may be good, they still are looking at the inherent risk here. And when you have things like Hyperliquid and Aster that are manipulating the markets, these banks and large institutions, they don't want to play that game. They don't want to be involved in that game because they don't want some overseas whale to draw the price down because they wanted to go on margin for hundreds of millions of dollars and 100x margin. And then that takes down crypto for another 2 years and puts everything back. The banks don't want to be a part of that, and they're not going to be. And so with that, you have to have stability in the markets. And that's what we're seeing more of. And that's part of diminishing returns. I think it was always inevitable that the banks would get involved in crypto and blockchain and all of that. But I think that it's also inevitable that they're waiting, and they have waited until we got past these ridiculous moves to the upside. And we're now that Wall Street and the banks are involved, we're seeing more of this diminishing returns and more sideways trading. I mean, you can see this cycle compared to the previous cycle and compared to the previous cycle and the cycle before that. It's more sideways. It's still up a little bit, but it's not banana zone, as Raoul Pal calls it. Anyway, let me know what you guys think. Don't forget to give the video a free thumbs up, hit the subscribe button, and I'll see you on the next video. Crypto on.